again. In this segment, Linda and I discuss how Canada Deposit Insurance Corporation increased its limits from the $60,000 up to $100,000, and how both of us were involved in that particular process to change the government's limits through Canada Deposit Insurance Corporation, and then also on to how we had influenced Jim Flaherty, the then Finance Minister, to introduce the tax savings account.
Okay, and then you yourself, I mean, I've known you for a few years, David, which is an honor to be here again today, but you have some really interesting credentials yourself that you bring to the table in your experiences.
Yeah, it's been really an immersion into an industry that's actually just growing. And I mean, we've had clients now, the same type of clients for 30, 40 years or so. And what we found throughout all of the existence of these interest rates and what the government do and the rates going up and down is that inflation just ate away at the $60,000 deposit insurance limits. By the time I started to look at that, and I did the calculations, and at that particular moment, that $60,000 in real money was only worth 37. So I, along with other members of the Registered Deposit Brokers Association, challenged the government, and certainly I did personally by interacting with J.P. Sabran, who was the chairman of Canada Deposit Insurance Corporation, and the powers to be at that time in the government to be able to move forward. And we did it in absolutely record-breaking time. I think it was in maybe 6 weeks.
Of course, the Canada Deposit Insurance Corporation is an insurance that protects consumers in the banks, and it was up to $60,000 per institution. Thanks to you, it's $100,000. And I remember, David, sitting up in budget lockup in Ottawa, and I actually jumped on your bandwagon and wrote about it a few times. And I remember sitting there going, my goodness, David just won.
Yeah, I know. It was a brilliant thing.
Yeah.
And, you know, the other part of that interaction with the government and this desire, this innate desire that we have to protect our clients and things. People might remember in the early 80s when interest rates were skyrocketing, you know, 18, 19, 24%. The government removed something which was called the interest rate deduction. So you, as an individual, could claim $1,000 off your interest, which would be tax-free. Well, come around the time that all of the stock markets were all doing well, but the general public was still suffering the fact that they didn't have any relief, where people with stocks and bonds and they had the dividend deduction.
Of course.
So I challenged Jim Flaherty a few times, just biting at his ear at his house about how inequitable all of that was, and it's certainly a complicated process. But what they did, they took this concept of the loss of this interest income deduction, and then they brought about the tax-free savings account, you know, which is a combination of both what they do in England with the gilts, and then they opened it up to make it far more useful for the general public, and it's just brilliant.
And more equitable, because we all know that a lot of people were forced into the stock markets, and then mutual funds became the heyday. But we know a GIC, no matter how low the rate is, unless we go into negative territory, it's guaranteed you're not going to lose your money. And we've been to the subprime crisis, and now, of course, a pandemic. People want to play it safe with their money.
Well, what we found, I mean, our normal client base age is running from like 55 up to the early 80s. And as you get older, you can't stomach those vast gyrations. And we've seen huge amount of money flowing back into the deposit system. We've had calls from some of the credit unions that we do go, we can't take any more money. We're just swamped with money. That what happens there is that you get this depression of interest rates. So though the market's going down, people need to get a better rate than what like some of the banks are offering basically zero
I
savings
know,
accounts.
I know.
And we're up to 2.5%, sometimes 2.60 in the 5 years.
So you go to Fiscal Agents, you're in probably getting a better rate than what the big banks would actually give you if you were purchasing
Well, of course.
from them.
I mean,
Yeah.
it's really simple to understand. The banks are really convenient.
Yes,
They're on every corner.
of course.
And that has a cost. I mean, each one of those branches might run, 40, 50 staff, all gyrating at different periods throughout this long day that they have. All that has to be paid for. And the way that you as a customer pay for that is in a lower interest rate, where when the institutions talk to us, they don't have those established costs. So what we can do is to bring all of these monies into the institution.
Yes.
And they only deal with one person, us as the broker. All of the investments are all registered in the client's name. The checks are made out to the institution. They're 100% safe, but they're getting a better rate. Now,
That's so important.
because we deal with 30 or so institutions, we've developed software to actually manage people's accounts.
Okay.
And that's called the MoneyGuard Deposit Tracker. And it will record for you as an individual those investments. You have your spouse, similarly, for her, separately, jointly. If you have children, jointly as well. And we can combine all of those in one particular set of statements inside the processes that we have, where we have an interest income tracker.
Okay.
So we calculate and record all of the interest rates that are paid to you. So by the time the end of the year comes, you've got a list of all your anticipated tax forms. So if you're missing one, you can check, and then you can check back with the institution.
So this is like a safeguard. This is absolutely brilliant.
Yeah.
Yeah. Well, for seniors in particular, as we know, RRSPs at age 71, they have to do a registered retirement income fund. And does your software help in that process as well?
Well, the industry itself is peculiar in the sense is that each one of the RIF calculations is slightly different.
Okay.
Because of the way that they've actually computed the interest. The biggest issue with trying to record that is that those institutions don't calculate it on an ongoing basis. So there's no real place that you can have 6 or 7 different RIFs and have those interest payments recorded, because the other factor is that you can just call the institution and say, send me some more money. We would never know. So what we do with that, we just put the original investment in, so you know where some of the clues of what it is. And if you wish to have us updated annually, then you just let us know, and we'll just adjust the figures or whatever you want to do with that.